Well, hello investors and traders. I'm LA Little and this is your weekly NeoTA wrap where we take a look at these markets and we do it from a neoclassical perspective, meaning each time we ask ourselves what happened in the past week and what does it tell us about the coming ones. Do this show every Sunday evening, broadcast at or before 10 o'clock Eastern Time. It's archived on YouTube under the channel LA Little. As far as what happened, it was a pretty brutal decline across most of these markets, with the S&P, the Dow doing the best of the worst. You had S&P only down 3.8, Russell down 5, and the NASDAQ 4.1. So a pretty brutal decline across the board. It was all week long. There was no lift. And then Friday, you had the bottom fall out of it with worries about junk bonds, mutual funds not being able to meet redemption request and actually closing those redemptions and saying they're going to orderly liquidate. It was a lot of concern as a result of that out of Third Avenue doing that action that gets people scared about what does the future hold. Is this the tip of the iceberg, or is the market about to just, crash and burn, that sort of thing? Probably not. It always looks bad when you see this kind of news, and there's always concern, but, the structure for a larger decline really doesn't look to be in place at this point in time. If we look at the S&P 500, for example, on a daily, we get a trend transition, you break a swing point low, but you're quite a bit a ways off the lows down here at 1871, and that's where you'd have to go to break out the bottoms down here. That's actually, let me get the number on it, 1867. You got a swing point low down here at 1954. So to really get something started, you got to break swing point lows on the weekly time frames, and that's still another 60 points down. Now, there's nothing to say it can't get down there. Matter of fact, if it does get down there, it's going to get ugly. But right now, it's another garden variety type pullback. Worries out the yin-yang as always. Federal Reserve coming up this week. They're going to lift rates. They're going to leave them the same. Is the market going to jump on that news? I mean, it certainly sold off into the news. Or is it going to continue to sell off? It's kind of the question we have to ask ourselves. And when you look at these markets, and if we look around at some of the others here as we go through them, looking at the NASDAQ, for example, it's just coming back to do a test on that swing point low. If you look at it on a weekly basis, it also is still up in the higher range up here. And what I mean by the higher range, of course, is this price point up here, these swing point lows and down. From there, you got another range underneath it, and of course the third range underneath that. So, the stronger indexes, NASDAQ, NDX, they're still up in the top range, just coming back at this particular point to try and test into that middle range, so to speak. If you look at the NDX, looks the same. The real worries is not here. It's not in the stronger ones. It's in the weaker one, and that in particular is the Russell. The Russell breaks multiple swing point lows to cave in on Friday. So you have one here that breaks, another one there, and this one here gets underneath all of them, breaks them out. Volume not huge, but now you've broken multiple swing point lows. The obvious place that it wants to go next is this gap area, and then underneath that all you have is the lows. Is the Russell going to break down and take everything with it? Well, the key point here is this 1100 mark. That's where all the volume lies, and it looks to me like it's going to try to get into that area potentially this week. So potentially more pressure coming. The weaker index definitely taking it on the chin, and if you go into the monthly on this, you can see a lot of trouble if you start getting much lower than that. These are those price points we were just looking, and if you go back to October last year, the number was 1040. A break under that would be the first major index to transition on the long-term time frame. Long-term time frames do not change very rarely, and when they do, it's significant. So if this Russell is to lead us down and break this point, that would definitely be something to be concerned about. But at this particular point, right now, it looks like a normal variety kind of pullback into a known news event, and many times those kinds of situations end up getting bought on the news. Now, one thing we had been harping on last week in saying that this was a big driver was the German DAX. This was doing an ABCD structure on the way down. We were watching this closely last week as kind of a tell, and when it broke underneath this B point, stayed under it, couldn't get back over it there, then it looked to us like it was probably going to try to trade all the way down to the projection. That projection is down in this area. It's only about 100 points from that. I would think that now that it's down this close, it's going to try to finish it off sometime early this week in front of the Federal Reserve. If you look at other countries, and rather than looking at specific ones, I'm just going to pop into the EEM and use that for an emerging market view of the world. Breaks swing point lows, breaks them with volume on the daily. If you look at it on the weekly, it's coming after the high volume lows. That's another buck and a half down, so another in this case another 4 or 5%. So that in itself is a pretty drop still to get there, but that at this point you have to say, hey, that looks like that's the target, right? Because you're coming under the last of the lows here and going after the final low. And all of this in a nutshell comes back to the currencies. The currencies are having huge fluctuations right now. The ECB did not expand the QE program. That was taken as a disappointment, and the euro bounced higher as a result. You got strength. So if there's not as much QE coming, then they start taking away the discount on that particular currency. The same sort of thing is happening over in Japan, where they're getting a nice big bounce. They've come all the way back up to a retest, regenerate zone, and they're testing into that now as part of the strength that we're seeing in these overseas currencies. So you're seeing it in the euro, you're seeing it here in the yen. On the larger scope of things, these are just minor bounces and large consolidations. That's true here. It's also true if we look at the euro on a weekly basis too. It's consolidations probably at best on the euro, maybe on the yen. That consolidation though is something different, and anytime you get fast currency moves, it tends to disrupt everything. And the other part of this that's happening right now is not a fast currency move, but instead a fast move in a commodity, and these commodities have been getting racked ever since the dollar had started to rise some year and a half ago. Oil falling out of bed, down 11% last week, just day after day after day of pounding. These markets continue to get beat up. West Texas Intermediate takes a huge hit. The oil market itself, via the ETF, continues to take a hit. And on a monthly, a weekly, a daily, it doesn't matter what you look at, they continue to get hammered. And that, of course, is leading to other sectors or other areas of the market getting hit, in particular what we talked about at the top of the show, and that is the junk bonds. High yield ETFs, JNK, it's a decent measure of that market, just collapses, volumes expanding, right? This is blowout type volume, so you're probably getting some sort of a blow-off move taking place. Third Avenue, which is focused on the bad of the bad junk, couldn't meet the redemptions, and they decided to just liquidate in some sort of an orderly way and froze the assets of those in it, which was kind of unprecedented for that credit fund. That fueled even more concern, and you saw that in this market and in any of the outside of Treasury, any of the credit markets began to get hit. Here's the corporate grade, investment grade corporate bonds. you can see how they continue to, they're not collapsing, but they're certainly not rallying. And if I look at, and I was looking for my other one, here's the high yield bonds. You got the same sort of collapse taking place here. Huge spike in volume. That's on the Friday, and you can see it on the weekly as well. Big volume spike, and also on the day, the monthly, going after the swing point lows. It's important to note here that this is the first time since the Fed started its QE programs that you're seeing debt of any type being sold off year over year. If we finish at the same price points that we're at now on the junk bond, it's going to be a year over year loss on those issues, which is the first time now since 2009. Is it a canary in the coal mine? Is the debt structure finally going to begin to implode? We know it's a huge problem. I don't think so. It doesn't look that way. We don't have the structure in place elsewhere to see the equity markets collapse. But it's not a good sign. Anytime you get fast moves in currencies, fast moves in commodities, and we're talking about large directional moves, especially if those fast moves come against a very heavily weighted trade against that move, like in the currencies, you get disruptions, and you're getting some serious disruptions out of all of this. So when we look at the overall market, are we going to see a fast decline? Well, if I look at the emerging market, it looks like death warmed over. If I look at Europe, not that bad. If I look at Japan, not that bad. And certainly if I look at the U.S. markets, also not that bad. The problem is that not that bad, just like we saw last week, can become bad if it continues. And we're getting far enough out now to where fairly soon these markets are going to have to lift. They're going to have to make new highs. We're going to have to see the S&P 500. We're going to have to see the NASDAQ. We're going to have to see those get over these highs and stay over them. Because if they don't, and they don't join the NDX, which had already done that, and pull along these other indexes that are weak, then eventually those long-term problems that are out there are going to start to manifest themselves as issues on the longer-term time frames. And then we're going to see the structure develop that allows these markets to take a bigger dive. Not there yet. Building the structure out, it takes a while, and right now it's slowly doing that. And if these markets do not rise over the next, I would say 3-4 weeks at max, then we're going to probably see a lot more risk come into the equity markets. Well, that's it for tonight. Tell a friend, tell two. I'm LA. This is and was your weekly NeoTA wrap. Have a great night and take care.